We're jumping into a topic today that, well, a lot of you seem really interested in, the investment ideas of the legendary Peter Lynch.
Yeah, he's definitely a big name in investing.
Absolutely.
Yeah.
You send in sources, his books, articles, discussions about his whole philosophy, and our mission really is to boil it all down, make it clear, engaging, something you can listen to.
Get those key takeaways, those aha moments.
Exactly. Help you grasp his core ideas without, feeling overwhelmed by all the detail. By the end of this, you should hopefully walk away with a pretty solid understanding of Lynch's approach.
Sounds good. And Lynch, he had this amazing knack for making investing seem less mysterious. A great place to start is probably his most famous idea. Invest in what you know.
Right. That's the one everyone mentions, using your own experiences, things you see every day.
Exactly. He really believed that your personal experience with products, with services, that could be a gold mine for investment ideas. Your local knowledge, as he put it.
That could actually give you an edge over, say, Wall Street analysts who might not be using that product or visiting that store.
Precisely. And he didn't just talk about it, he did it. The classic example, you see it everywhere in the sources, is Dunkin Donuts.
Ah, yes, the coffee.
Right. His initial thought wasn't from some complex analysis. It was because he was a customer, saw how busy they always were around Boston, and he was genuinely impressed with the coffee.
It's just an everyday observation.
That observation was the spark. But, and this is crucial, Lynch always stressed that noticing a good coffee shop is, well, just the beginning.
It's not the end of the story, is it?
Not at all. It's a lead, a great starting point. But then comes the real work,
Yeah.
the fundamental analysis. He was huge on that.
Okay, so you like the coffee, you see the crowds. What next?
You dig deeper. You look into the company's financials, its earnings prospects, where it stands against competitors, what its plans are for expansion. Look behind every stack, understand what makes the business tick.
So it moves from personal experience to hard research, getting beyond just liking the product.
Exactly. You need that thorough understanding. So once a company's on your radar, maybe from your own life, Lynch says hit the books, hit the numbers.
And what kind of numbers, what financial metrics did he really focus on?
Well, he was quite pragmatic about it. He definitely looked at core stuff, sales growth, earnings per share growth. Those were vital.
Makes sense.
Yeah.
If the company's earning more, the stock price should follow eventually.
That was his thinking. Rising earnings often lead to a rising share price. Then there's the PE ratio, price to earnings.
Right, a classic valuation metric.
Yeah, but he always emphasized looking at it in relation to the company's growth rate. His sort of rule of thumb was that a fairly priced company might have a PE that's roughly equal to its growth rate.
Okay.
And he definitely warned against really inflated PEs, where the price seemed way out of line with the actual growth.
Which brings us neatly to the PEG ratio, doesn't it? That's heavily linked to Lynch.
It really is. Lynch is often credited with popularizing the PEG ratio. It's simple, right? Just the PE divided by the earnings growth rate.
Yeah.
He often looked for companies where the PEG was around 1, or even, ideally, below 1.
Suggesting it might be undervalued relative to its growth.
Exactly. That's the core of his growth at a reasonable price, or our ARP idea. Finding growth, but not overpaying for it. Now, there isn't some magic Peter Lynch formula, but the PEG is a big part of his toolkit.
You even see things like Peter Lynch fair value calculators online based on that idea.
You do. But it's important to remember, Lynch would say the PEG is just one tool. You use it alongside everything else, not in isolation.
Okay, so PEG is important, but what other financial aspects caught his eye?
He'd also glance at the dividend yield. Sometimes that could signal a more mature, maybe slower growing company.
Right.
Debt levels were a big one. He really preferred companies with strong balance sheets, manageable debt. You need to understand if the company can actually pay its bills. He'd look at cash flow trends, too, and whether profit margins were expanding. That's usually a good sign. But again, he always insisted you look at these numbers with a real understanding of the actual business, the qualitative side.
Right, the numbers need context, which leads us to another big Lynch theme, understanding the company's story. What did he mean by that?
The story. Yeah, that was fundamental for him. It wasn't just about stock symbols. It was about grasping what the company actually does, why it might grow, and maybe why the market isn't seeing its true value yet.
Go.
He had this concept of the 2-minute story. Could you explain the business simply, clearly, maybe even so A kid could get the basic idea.
Like an elevator pitch for your investment?
Pretty much. It forces you to really boil it down. And crucially, he said you have to keep checking that story. Does it still hold up? Have things changed? Maybe growth is slowing, or they made a bad acquisition. If the story breaks, maybe it's time to rethink the investment.
That 2-minute story is a great way to frame it. Helps keep things clear. Now, he also categorized stocks, didn't he? Into different groups.
He did. Very practical, actually. He had 6 main categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Why bother with categories?
It helps set expectations, and you analyze them differently. Stalwarts, think Coca-Cola, Bristol-Myers, reliable, big companies, but probably not going to give you explosive growth.
Okay.
Asset plays are all about undervalued assets on the books, like maybe some real estate companies. Cyclicals, like automakers or chemical companies, follow economic cycles.
Right, they go up and down with the economy.
Exactly. And his advice for those was, try to sell them near the end of the upswing before the downturn hits. So the categories help you tailor your approach.
Makes sense. And if you're looking for those big returns, those 10 beggars he talked about, what was his advice?
Long-term perspective. That was absolutely key for Lynch.
Patience.
Loads of it. He was a huge advocate for long-term investing. Ignore the market's daily or weekly jitters. Focus on the company's ability to grow over years.
That's where the 10 beggars come from, right?
Yeah.
Stocks that go up tenfold.
Exactly. But those huge returns, they don't happen overnight. They usually take years, sometimes many years, to play out. He had that great line, "Watched stock never boils."
Yeah, so resist the urge to check it constantly.
Pretty much. Focus on the long game. It actually fits well with, respecting people's time. It's about patient growth, not frantic trading.
And on the flip side, he warned against trying to, time the market perfectly or chasing whatever stock is hot this week.
Oh, definitely. He was very skeptical about market timing, trying to predict the highs and lows, or forecasting interest rates, the economy. He thought that was mostly a waste of time for individual investors.
Better to focus on the companies themselves.
Much better. Spend your energy understanding the businesses you own or are thinking about owning. Don't get overwhelmed trying to be an economist.
He also really hammered home the importance of financial stability, didn't he? Which brings us to the balance sheet.
Absolutely critical. He had that famous quote, something like, "If you can't understand the balance sheet, you probably shouldn't own it."
Pretty blunt.
Yeah, but it makes sense. You need to have at least a basic grasp of a company's assets, its liabilities, its equity. Is it drowning in debt? Does it have enough cash? It's fundamental to knowing if the company is financially sound.
And checking that wasn't just a one-off thing.
No, definitely not. He stressed rechecking the investment thesis regularly. Are the reasons you bought the stock still valid? If the company's fundamentals are deteriorating, if the story has changed for the worse, that's a potential signal to sell.
So stay engaged with your investments.
Right. It's not set it and forget it entirely. Now, underlying all this was a real belief in, common sense.
Common sense over complexity.
You got it. He really championed using simple logic, your own observations. Sometimes just noticing things in your daily life can be a more powerful investment tool than some super complex financial model. That accessibility is a big part of why his ideas caught on.
Okay, let's dig a bit more into what makes a company attractive in Lynch's view. He talked a lot about competitive advantage, right?
Yes, the competitive moat. That was huge for him. What gives this company an edge over its rivals? Is it a strong brand people trust? Some unique technology? A killer product? Maybe they're just the lowest cost producer.
Something that protects its profits?
Exactly. Something that makes it hard for competitors to muscle in and steal their business. He always said to look at how a company stacks up against its peers. Is it actually better? Why?
And he also liked companies that found a specific niche.
Yeah, that was interesting. He realized a company could be really successful by dominating one particular corner of the market, even if it wasn't a huge, fast-growing market overall.
How so?
Well, think about it. A company in a sort of boring, slow-growth industry, but with very few serious competitors, might actually be more profitable, a better investment than a company in a super exciting, high-growth field that's just packed with cutthroat competition.
Like his Philip Morris versus Xerox example.
Precisely. Philip Morris was in tobacco, not exactly a growth industry, but it dominated and was hugely profitable. Xerox was in the booming copier market, but the competition was intense, which hurt profitability. So dominating a niche can be very powerful.
So the market position, whether it's a leader or just one of many, really matters.
It's critical. Is it the big fish? a rising star, or just struggling to survive against bigger players. That tells you a lot about its potential.
And high competition, even in a growing industry, can be a bad sign.
Definitely. If everyone's fighting tooth and nail for customers, it's really hard for anyone to make good money consistently. That's why just finding a growing market isn't enough. You have to look at who's in it.
Which ties into his research methods, like scuttlebutt.
Right. Scuttlebutt. That was his term for doing some real-world digging. Don't just read the annual report. Talk to people. Talk to customers, suppliers, maybe even competitors or former employees if you can.
Get the gossip, the inside scoop.
Kind of, yeah. Get insights you won't find in the official documents. How good is the product, really? How tough is the competition? It's about validating the story.
And what about profit margins? What did he look for there?
High margins can be great, obviously. It might signal a strong advantage, pricing power. But he'd also be a bit cautious. Are those margins too high? Will they attract a flood of new competitors who will drive them down? Sustainability was key.
So understanding the competition was just baked into understanding the whole company's story.
Absolutely. You can't separate them. The competitive landscape is a huge part of whether that investment thesis makes sense long term.
Okay, let's shift to mistakes. Lynch was really good at pointing out common errors investors make.
Oh, yeah, he saw plenty. And a lot of it comes down to psychology, behavior, like the classic, it's gone down so much it can't possibly go lower.
Famous last words.
Right. He showed examples where stocks just kept falling. Or the idea that, oh, it'll eventually come back. Well, sometimes they just don't. Companies can fail.
And the, it's only a $3 stock, how much can I lose? Right. Trap.
Exactly. You can still lose 100%. Doesn't matter if it's $3 or $300. Percentage loss is what counts.
He also wasn't a fan of trying to predict the market's next move, as we said.
No, he thought that was mostly futile. His joke about spending 14 minutes a year on economics and wasting 12 of them, that sums it up.
Focus on the company, not the crystal ball.
Right. And avoid getting caught up in the hype, chasing the hot stock everyone's talking about. Also, just because a stock price is rising doesn't automatically mean you were right about the business. The market can be irrational short term.
What about diversification? He had a specific take on that, too.
He did. He coined that term, diworsification.
Diworsification.
Yeah, like diversifying badly, buying too many things you don't understand, or when companies buy unrelated businesses that just drag them down. For individuals, he suggested focusing on a number of companies you can actually understand and follow properly.
Quality over quantity.
Pretty much. And don't just blindly follow tips or expert advice. Do your own homework, trust your research.
And learn from mistakes.
Absolutely critical. Everyone makes mistakes in investing. The key is to figure out why you made it, learn from it, and don't repeat it. And control your emotions. Research should drive decisions, not fear when the market drops or greed when something's shooting up.
It sounds like a lot of it comes down to discipline and independent thinking.
That's a huge part of it. Which actually leads to another really interesting point Lynch made. The individual investor's edge.
Right. He didn't think individuals were at a disadvantage compared to Wall Street pros.
Quite the opposite. He argued individuals have real advantages. You're not managing billions, so you can invest in smaller, potentially faster-growing companies that big funds can't touch.
Right.
You don't have committees approving every decision. You don't have to worry about quarterly performance pressures in the same way. You can avoid groupthink. And you have that invest in what you know edge we talked about earlier.
Like his wife Carolyn noticing leg stockings were better quality.
Exactly. Or Maggie Gilliam stumbling upon the limited in a mall. Those aren't insights you get from a Bloomberg terminal. They come from being out in the world.
So leverage your everyday observations.
Absolutely. It's a potential advantage. And this connects back to finding those potential 10-baggers. What did he look for there?
Yeah, big winners.
Consistent earnings growth was key. Businesses that could scale up, grow bigger without costs spiraling out of control. A strong market position.
Right.
Think Apple, Nike, those kinds of stories over time.
Right.
Interestingly, he also said potential 10-baggers often have like dull or ridiculous names, or they operate in boring, maybe even disagreeable industries.
Why is that?
Because Wall Street might ignore them, they fly under the radar, glamour stocks get all the attention, but sometimes the best opportunities are in less exciting places. And smaller companies, remember, need less absolute profit growth to achieve a huge percentage return on their stock.
Makes sense. And what about when the whole market takes a nosedive? Panic time.
Not for Lynch. He saw market declines as normal, like a January blizzard in Colorado. Inevitable, maybe unpleasant, but part of the climate.
So expect them.
Expect them and see them as opportunities. When good companies get dragged down with the rest of the market, that's your chance to buy quality stocks at bargain prices. But you need that emotional strength, that fortitude, to buy when everyone else is scared.
Focus on the company, not the fear.
Exactly. Ignore the scary headlines. Stick to your research on the business fundamentals.
We mentioned the 2-minute drill before. That simple explanation sounds like it was really core to his process.
It really was, being able to state clearly, here's what the company does, here's why I think it will succeed, and here are the risks. If you can't do that simply, he argued, you probably don't understand it well enough to own it. It forces that clarity we talked about.
And patience, again, that seems to be a recurring theme.
Huge theme. He stressed that the really big wins, those 10 baggers, typically take 3 to 10 years or more to play out. You have to let compounding work its magic. Don't interrupt the compounding, as he put it.
So fundamentally, it's about the business, not the stock ticker moving up and down day to day.
That's the essence. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. Simple, but profound. He liked understandable businesses, not overly complex whisper stocks with maybe no sales yet.
Right.
He even preferred moderately fast growers in industries that weren't necessarily high growth overall, less competition maybe. And he liked seeing management with skin in the game, owning a lot of stock themselves.
Aligns their interests with shareholders.
Exactly. And finally, be willing to prune your portfolio. Sell stocks if the story truly breaks down, and rotate that money into better opportunities based on, again, fundamental changes.
Okay, so bringing this up to today, we see discussions online, Reddit, places like that. Is the Lynch philosophy still relevant with, giant tech companies, cloud computing, everything that's changed?
It's a great question. And what's interesting is, yes, the landscape changes. Tech giants dominate in ways maybe unforeseen back then. But the core principles, understanding what you own, focusing on fundamentals, competitive advantages, long-term thinking, those seem remarkably durable.
Still applicable, even if the specific companies look different.
I think so. You see people in those online forums still trying to apply his ideas, identifying moats for tech companies, looking at growth relative to price, understanding the business model. The underlying wisdom holds up pretty well.
We even have this Merck chart example from the
Yeah.
70s and 80s. What does that show us?
Yeah, the Merck chart. It's a fantastic illustration. You see, the stock price was kind of flat for years, like 72 to 81. Didn't do much.
Frustrating for an investor, probably.
You'd think. But look at the earnings. They were growing steadily the whole time. The annotation on the source material even says that was a good sign to hang in there.
And did it pay off?
It did. Eventually, the stock price caught up with the reality of the growing earnings. It's a perfect example of focusing on the business performance, not the short-term stock wiggles, and having that long-term patience.
A visual representation of his philosophy. Okay, so let's try and wrap this up. This deep dive, we really aimed to pull out the core ideas from Peter Lynch.
Yeah, the key takeaways. Understand the business. Do your homework, the fundamental analysis. Think long-term. And use your own knowledge, your everyday experience, as a starting point.
It's about being an informed owner of a piece of a business, right? Not just gambling on stock tickers.
Couldn't have said it better myself.
Well, thank you for walking us through all that. Really insightful stuff.
My pleasure. It's always good to revisit Lynch's wisdom.
And for everyone listening, here's something to chew on. Think about a company you interact with all the time. Maybe a store you shop at, a product you use, a service you subscribe to.
Okay.
Can you articulate its 2-minute story? What does it do? Why is it successful? Does it seem to have any competitive advantages? And then, thinking about Lynch, what's the first bit of fundamental research you might do to see if there's more to that story?
That's a great exercise. Puts the principles into practice.
Exactly. If this got you thinking, definitely check out Peter Lynch's books like One Up on Wall Street. There's so much more detail there. Thanks again for sharing your sources and joining us for this deep dive.